How do rising interest rates impact callable debt? And what exactly is callable debt? And why should you care? Scott Terrio is here. We're going to discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Scott Terrio, welcome back. You are actually in studio. I think many of your appearances here have been over Zoom, so good to have you up here in the Debt Free in 30 studio.
Nice to be
Kitchener.
back in the mothership.
The mothership, as it were. So today we're going to talk about this concept of callable debt and unsecured debt and increase in mortgages and all the rest of it. So let's start with some basic stuff here. So this podcast will air in September. So it was of 2022, starting in March of 2022, interest rates have been going up. And so why should we care? Why should you and I care about mortgage interest rates? And the reason I ask that question is Hoyes Michaelis, the company we work for, does consumer proposals and bankruptcies, which deal with unsecured debt, which is things other than mortgages. So why should we care that mortgage interest rates are on the rise?
Yeah, good question, especially for the general public. Comes down to there's only so much household monthly income to go around. So if you are experiencing an increase in your mortgage payments by, I don't know, a few $100 as a result of rates going up, having to renew your mortgage, whatever, that's a few $100 you're not going to have to spend on everything else. And you're not going to stop eating. You're probably going to do a few things to modify your groceries and spending and that kind of thing. But your other debts are due, and those are unsecured debts. And as we know, our average filer has about $50,000 in unsecured debts, and those have to get repaid in minimum payments every month. And so if your mortgage went up $300 or $400, that's $300 or $400 you're not going to have to spread around to those payments. And so what that means is eventually people will kind of hit the wall. So they'll do what they need to do. The mortgage will get paid.
Well, and that's a key
first
point
and foremost.
There. When someone comes in to see you, how often are they behind on their mortgage payment or their rent?
Never.
That's the first thing that gets paid every month.
Never.
It comes automatically out of your
shelter.
bank account.
You can't skip it. It's maybe rent a couple of times, but your mortgage, no. And Canadians aren't wired that way, right? We know that Canadians will pay their mortgage absolutely before they let anything else go. And so and that's why it matters to us, because at some point, if you're forking out more money for your mortgage every month due to rising rates, then something's going to slide. And if you are maxed out on your credit cards, or you get maxed out by using those cards and limits on credit cards and lines of credit to pay other things such as other lines of credit and credit cards, which is what people do who are desperate, eventually you hit the wall and you can't do that anymore. And that's when they will come to see us.
So I said in the intro, we're going to talk about callable debt, which is a phrase that I never hear in the media. I don't see it on, Facebook or Twitter or TikTok, or if I was on those things, I might see it. But so what is callable debt? Why are we talking about this? What is it? Why is it risky? What's the issue with
callable debt is a technical term, but it's a very broad one. What it means very technically is that the bank or lender can call the debt. They can say, you got to pay us this whole thing back now. Of course, they wouldn't do that unless there was a situation, a delinquency, usually a major one. But more broadly, what it means, and in more practical terms, is that the debt that's been lent to you, and in this case, I'm referring specifically to Helocs, home equity lines of credit, because they're kind of the biggest classic callable debt. Is they're fully open terms. And so what that means is the bank has a lot of latitude for changing the rules. And it's worth noting that the banks aren't changing rules that they can't change, because banks play by the rules. So for everything else you'd say about banks, everything's vetted 500 ways legally, and they don't do things that are not right and not legal.
The banks play by the rules that they create.
Yes, they do. But what I don't want people to think is the banks are moving goalposts that aren't movable. They're very movable. And that's the thing about callable debt, is that in the case of a delinquency or any kind of breach of the original terms, the bank can then change the terms. And what they would usually do is say, okay, well, formerly you had prime minus or plus whatever. Well, now it's going to be prime plus a whole bunch more. And the motivating factor there is, first of all, banks don't want to be homeowners. Okay, and it's certainly not widespread homeowners, and that's why this fear of like widespread callable banks calling a ton of HELOCs isn't going to happen, because banks don't want to be massive homeowners. But what they do want to do is make money, and banks are publicly traded companies, and they report quarterly, and that drives behavior in the banks that means let's make more money. So, and raising your interest rate makes them more money. So if you go delinquent, bank goes, okay, we'll just charge you a whole bunch more because it says so on page 17 at the bottom, and you didn't read that when you got your
fine
mortgage.
print.
So that's more what callable debt is.
Yeah, and you're right. The word callable is kind of descriptive. Okay, we can call the loan back. In practical terms, you gave one example. The bank could say, well, your interest rate was 6%, now it's 7%, now it's 8%, now it's 9%. But they can also change the amount of your line of credit. And this, you were just discussing it in terms of HELOCs, a home equity line of credit, but this applies equally to an unsecured line of credit. And frankly, it applies to a credit card too. The bank could say, well, you've had a $30,000 limit. Now your limit's $20,000. Yeah.
So in other words, I'm glad you raised that, because it isn't just interest rates. It's they cap your limit. They can do all kinds of things. I mean, for one thing, they're minimizing their exposure by doing that. So it's a risk adjustment on the bank's part, but it's also a profitability adjustment because now they're charging you more. If you think of it like it's a form of consumer forbearance. So when in business lending, when a business goes south and sour, and the special lender guys have to come in from the banks, what they'll do is engage in oftentimes what's called a forbearance. So they'll make you a deal where, okay, in the next 12 months, if you pay this, this, and this, we won't close you down. So it's kind of a consumer version of that.
Yep. And they can do it. So like you said, this is perfectly legal. They can do it. So they will do it when they, like you say, they start to notice that there's difficulties. A lot of banks do a soft hit on your credit report every 3 months. So you don't even know they've done the credit check. But if they see that, oh, your other debt is increasing, maybe there's been a job change, you've moved, something like that, there's a bit more risk. Well, maybe what we're going to do is lower your credit limit, raise your rate, whatever. And that's what callable means. And that's in contrast to the mortgage that you got that is fixed for the next 5 years. They can't change the interest rate if it's locked in for 5 years. Or your car loan, a 7-year car loan, well, the interest rate doesn't change.
Yeah, and it matters because so many people have used HELOCs in the last 5-7 years. I mean, it's just become widespread all over Canada. And so this matters because most mortgage borrowers also have a HELOC. Well, this is what you should know about your HELOC, because if you do get into trouble, which is what we're going to see in the next little while because of rate increases and inflation and all these other pressures, then you probably should have a look at what could possibly happen with your lending vehicle.
Yeah, so that's why we're doing this episode, to put this information out there. Will there be more unsavory borrowing or defaults on other loans happening to keep up with higher mortgage payments? So you already said that Canadians will prioritize a mortgage payment or a rent payment over anything else. I mean, it's very common for people to walk in and owe money on taxes because the government isn't calling them every month, so they don't pay that. It's not as urgent. So do you expect to see, higher defaults, more issues going forward?
I do, because people will get desperate. And what happens when people get desperate is they do desperate things and they don't think correctly and they kind of lunge around for a solution. And the issue that Canadians face in the last few years, more so than before, is the absolute proliferation of these alternate lending installment loans. And so what's happened is, as they tightened down payday lending 10 years ago or whatever it was, that inadvertently drove installment lending, which means that the former payday lenders and some of the secondary lenders out there are offering, $3,000, $5,000, $7,500, $10,000, $12,000, $15,000 loans to people, but they're offering them at 48% interest. And so we see a lot of these now, many more than we used to. I've talked about this before. And the issue is, once you're in those, you're probably close to done because you got it while you were desperate. You did it in oftentimes an effort at consolidation because the numbers are large, right? So if you can get 10,000 or 15, you can consolidate 2 or 3 other debts. which sounds nice because you go to one payment, but it's at 48%. So your borrowing cost ends up being almost as much as the amount they lent you, and you end up hitting the wall.
Yeah, your credit card was a really high interest rate at 19.9%, but 40% is twice as much. So you are now paying twice as much.
Yeah, and the other issue is that these are so widely available now. Like it's everywhere.
Do these guys advertise at all?
And this is where, your search history comes in, right? People who are desperate in terms of their credit are searching stuff, oftentimes at 3 a.m, they're typing in things to do with debt and credit and all this stuff. And so you will end up with pop-up ads because of that. And these guys have gotten quite expert at this. And any kind of social media will also include the same thing. And it's just, they've made it so easy to get them. And because most of these transactions are now done online, there isn't even that kind of personal barrier to keep you out of the place physically. Like, it's hard to go to a payday lender because you got to walk in and there's bars and there's big yellow signs and everybody's looking at you. If you can do it on your couch at 3 a.m, guess what? And so that's what concerns me is the ease that which this has become.
Yeah, and I think COVID had an impact on that, because in the past I had to go into a branch or a store, as they call them.
It made it worse.
And now I can, like you say, do it from my phone online, and it's much easier. So, speaking specifically about homeowners, do you expect we will see more insolvency? So for people watching this, and Ted and I have talked about this before, the number of insolvencies kind of peaked in 2008, 2009, then it fell for almost 10 years, and it was starting to creep up in 2017, 2018, 2019, and then the pandemic hit, boom. The number of insolvencies filed in 2020 and 2021 went way down, and they were still down for the first half of 2022, kind of picked up a little bit over the summer. And you can tune in for the Bet with Ben Rabideau to see how that turned out.
As we're wrapping up August,
exactly,
waiting patiently for the numbers.
Waiting for the numbers. So insolvencies have been down. They're now starting to creep up. But as you said at the beginning, insolvencies deal with unsecured debt. So do you expect to see homeowners, people with secured mortgage debt, filing insolvency more than they have in the past?
Predictions are a fool's game, as Ron Butler wisely says, but I'm going to do it anyway. Yes, I do, because for a few reasons. One is, and I will cite the Hoyes Michaelis Homeowners Bankruptcy Index, the HBI.
The HBI, yes.
Which basically just says how many of our insolvency filings in any given year are homeowners. It's a percentage, and it's like at 1.7 or whatever it is now.
Yeah, the last couple of years it's been close to zero, between 0 and 3 or 4%.
Yeah, and there's all reasons that are understandable for that, right? I mean, homeowners have access to a lot more tools to avoid insolvency, like Helocs and home equity and stuff, than renters do, so they haven't been filing because they haven't needed to. So for that reason alone, it's probably going up just because it's at an all-time low and it's been suppressed for so long. More so is the interest rate increases and the very obvious effect that's had on the housing market. Everybody's freaking out. And so combine that with inflation, and homeowners are not immune to inflation. Homeowners may be immune to insolvency when rates are low and equity is rising, but they're not immune to inflation. In fact, they might be more sensitive to it just because of all the other trappings that come with a house. And so I expect that to rise because of those two issues.
And homeowners benefited from lower interest rates for 10 years, which made real estate prices higher and higher and higher. Now that real estate or interest rates are going up, that obviously is inversely proportional, makes real estate more or less affordable, drives prices down. And the inflation we had in 2020, 2021, and I'm grossly oversimplifying this, but that extra money went into things like the stock market and the real estate market. But now that inflation, if you want to call it that, has filtered its way into real prices, what you pay at the grocery store and the gas pumps and so on and so forth. Unavoidable stuff. So now I've got to be putting the money into that, less money to be spending on real estate. And the Hoyes Michaelis Homeowners Bankruptcy Index, which is aptly named, I think, in 2011, it was around a third of our clients owned a home at the time they filed. And now, as you said, it's down to 0. I'll put a link in the show notes so people can follow along. We update it every month. So
it's almost impossible to believe that right now. It is
33%
or whatever it maxed out at.
Well, and it is also true that homeowners obviously have more debt because they have a mortgage, but they also have more unsecured debt.
Yes, they do. About 20 to 25,000 more than renters typically.
So think about that then. If our typical client has 50,000 in unsecured debt, credit cards, bank loans, all that kind of stuff, a homeowner might have $70,000.
Yeah, and it's because of it's expensive to own a home. There's more trappings. There's more temptations to pad out your home and do things like that, and it's just more expensive. So it makes more sense that homeowners tend to have quite a bit more.
I'm going to put a deck on the back. I got to buy a new couch. I got to paint the place. The roof leaks. I got to fix
or something
that.
Goes right.
Yeah.
It's like the hot water tank's gone, and the furnace is going to be replaced.
If I'm a renter, that's not my problem.
Yeah.
But fortunately, as a homeowner, I've got perhaps equity I can tap into, and the banks are more than happy to lend because they see you as a better credit risk. So what are you seeing now of the people who are calling us up, coming in with debts? Are there any themes, trends? What's happening on the ground?
There are themes and trends. Number one is we're seeing more homeowners, I think. I hadn't spoken to a homeowner. Now I work out of Toronto, so it's maybe less so than other outer offices because we're all across Ontario. But I hadn't spoken to a homeowner for like couple of years, and I've probably spoken to a dozen in the last few months, and it doesn't sound like a lot, but it is a lot when you haven't spoken to any, zero. And all of a sudden they're calling. And so because they've been so immune from having to call us, and they're not all filing, but the fact that they're calling and raising concerns, and they're probably not far from filing, like maybe they're 6 months from filing, or whenever their mortgage comes up for renewal, that's going to break their back. Or as I said earlier, once they max out their unsecured credit cards, lines of credit, maybe they can't do it anymore. So we're seeing that for sure. We're seeing much more collection activity.
And just on your point about homeowners, I think we will be hearing from a lot more of them in 2023.
Oh yeah.
In the
2023 is the year for
that's probably it. Yeah. And you're right. If I've got a mortgage that is a 5-year mortgage and it's been going for 3 years, well, nothing's changed for me. Yeah. But when the mortgage comes up for renewal and I was paying 3% and now I'm paying 6%, that's a big number.
Yeah.
Or if I have a Heloc, which in almost all cases is a variable rate mortgage.
It's gone up already.
It's already gone up.
Yeah.
And so now I'm starting to feel the effects. So
so the Heloc going up might not hurt you too badly for now. And inflation, maybe it drops off, we get it under control next year, but then your mortgage comes up at some point. It really, 20% of all mortgages should be coming up every year if it's 5 years. So, I mean, if you think 1/5 of every one of the next 5 years, there should be 1/5 of mortgages where people are like, well, now rates will eventually go down again and it won't be as much of a concern, but probably for 23 and 24, it's going to be an issue.
Yeah. So we're going to be seeing that. So when we look back over the last couple of years, and, we've discussed this on the podcast before, we had lower insolvencies because the courts were closed. Mm-hmm. Now the courts are open. Are you seeing greater collection activity, legal collection activity?
Yeah, on the part of lenders, we're seeing much more collection activity and aggressive. It's not just banks going after people; it's banks having their lawyers go after people. And because, look, for 2 years the courts were largely closed, not entirely, but they got so backed up because of that. That it didn't make a lot of sense for banks to pay a lawyer to take you through the 3-step process in civil court that takes 60 days under normal circumstances or whatever, to come after you for, I don't know, $5,000 or something. And so that's happening for sure. COVID also had some effect, not just on closing the courts, but people were out of work. 9 million Canadians were put out of work instantly in March 2020. And when you're out of work, you got no wages to garnish. So the banks backed off and said, well, again, it's no point paying the lawyer who's on staff or, pick your big bank, to go after somebody who's out of work. Yeah.
And 9 million Canadians received CERB in 2020. So that's where you're getting this out of work stat.
Yeah,
now,
I didn't make it up.
Whether they legitimately were or not, that's not the point. It obviously crimped their ability to pay. So yes, I would agree that collection activity and legal collection activity, because again, if you're going to sue someone, you have to send them the paperwork.
Yeah.
kind of hard to do if you're working in your basement. If you're CRA and you have to send a requirement to pay notice, same thing. But yes, when someone files a proposal or a bankruptcy with us, if they're being sued or their wages are being garnished, we issue a stay of proceedings, which stops that. We didn't issue a whole lot of those in 2020 or 2021.
Don't need to. Yeah.
But we've certainly issued a few in April, May, June, July, August, September.
Yeah,
this
I'm
year.
doing a lot more of those when I do filings now.
So it's definitely something that has it's definitely changing. Yeah. So
what we did see during COVID was a lot of letters, because oftentimes a letter will be enough to freak you out into paying. And so, lawyers and banks were sending lots of letters, but the banks knew they weren't going to do anything. It was an idle threat, but the idle threats work a lot when you're under a great deal of stress from debt. And we have a lot of people who phone us and say, well, I paid them last month because they sent me a letter. Well, you're out of work. You didn't need to, but they don't know that.
Yeah.
And so that's part of what this podcast is all about, is, making sure people understand that, your rights when it comes to being unemployed and what banks are trying to get from you. And that
you can't have your wages garnished if you don't have any wages.
Right. And they can't take government.
Yeah, they can't take your CPP or OAS income, or anything like that. Yeah. So you've got the segment of the population that are homeowners, and then you've also got a segment of the population that we deal with who are small business people. And these are people who, again, during 2020 and 2021 might have had their businesses closed, significantly curtailed. So are we seeing people who are, or do you expect to be seeing people who are both homeowners and small business owners? What do you think the future looks like there?
Yes, I think now that we're seeing homeowners generally, we will see that eventually. I don't know if it'll be out of proportion to the number of small business owners who are homeowners in the general population. Probably won't be. But it might be because small business owners were put through the ringer in the last couple of years. Well, not all of them, but a lot of them. But the ones who were, any kind of service industry or any kind of, business that involved human contact, or, those guys got crushed. And what a lot of them had to do was resort to, I hate to say it, but not remitting HST and source deduction, payroll deduction taxes to the government quarterly, because they were using it to stay open. And they were using it to not fire people or whatever. And so, their intentions were good, but now they're backed up with all this debt, and we're seeing a lot of that. And so if you're a homeowner who is a business owner who has all that owing, you owe those things personally, because that's director liability debt. And CRA can raise a personal assessment against you when it was originally business debt. And if you have a home with equity, that means that CRA could put a lien on your house. They could, because they're not going to get your wages because you're self-employed. So it's very hard for CRA to go after self-employed people that way. But they can certainly freeze their bank accounts, which means you can't operate, which means you can't pay your mortgage.
Yep. And this is something that, again, I think we're looking at for 2023. Because
it's not right now, but it's coming.
I haven't seen CRA put a lien on someone's house recently.
No.
Because, again, it's a complicated procedure.
I don't want people to think that's happening yet.
Right.
But these things are all in the pipeline.
Yep. And it's the power that they have, so it's something that they will.
And CRA has been freezing a lot of accounts. And so if CRA is in that mode, and they tend to go in steps, CRA, right? They tend to have directives. So it's like they send a whole bunch of letters. And then their next step a few months later is they freeze some bank accounts. And then their next step is who knows. And so maybe the lien thing is going to start at some point next year if they're not paid, right? If you ignore them long enough, well, maybe that's step 3.
Well, and we've certainly seen some bank account freezing over the last few weeks.
Yeah,
this
lots
is
of that.
Something that was not very prevalent and now is. Yeah. So we already talked a bit about credit options tightening. So I'd like to go on to kind of, okay, what's the future look like here? So, and again, you've already quoted our friend Ron Butler, who says making predictions is silly.
Ron's going to laugh at me.
So exactly. He's wiser than both of us.
I don't think I answered your prediction on the house.
Well,
HBI.
So let's start with that one then. So the homeowners bankruptcy index right now, we're into the 0 to 2% range. Virtually none of our clients own a home. Do you expect that to increase over the next year or two?
I do. I think it'll take time to play out. I don't think we're going back to 33%, just because the housing bubble is too big, and they're not going to keep raising rates to 15% and wipe everybody out. It's not going to happen. Like the Bank of Canada is going to have to follow the Fed to a certain extent, but there's going to be an awful lot of political pressure on the Bank of Canada to also trim things back at some point, maybe when they even shouldn't be, and because homeowners are voters. I think we know that. And so I would expect, I'll say half. What's half of 33? 16 and a half?
Yep.
Okay, there I'm on record, Ron.
So over the next, over what time period? Over the next year? Over the next
I think
2
it's
years?
over the next 2 years.
Yeah. And I think that kind of makes sense because that's how things go.
It's probably a little aggressive, but I if it came down by 32 or whatever over the course of 7 or 10, maybe it can go up because I think people got overextended.
Yeah, and it all depends on how far does the real estate market fall, how high do interest rates go up. If the real estate market levels out, then okay, maybe it's not a big deal.
Yeah, the housing psyche is a big thing in this country, right? Like it's taken a big hit in the last little while, even though rates are still awfully low relative to the history.
Yeah, you look where they were in 1980. It's
but for anybody who's under a certain age and has never experienced that stuff directly, then rates are way up, and they're starting to realize that their notion of housing going up 20% every month forever is not real.
Yeah, and so great, I'll go and buy a condo and I'll rent it out, and it doesn't matter what I pay, and it doesn't matter if I'm losing $500 a month from a cash flow point of view because it goes up by $1,000 a month, so I'm good. Yeah. Well, once it's not going up by $1,000 a month, all of a sudden now it matters. Yeah. And so that's, I think, the big change in psyche. So okay, so let's so I think you've kind of answered the question that this high rate climate's going to exist for a while. I mean, I'm on record as saying that I think, and I made this prediction back in January, that inflation would be lower by the end of the year than it is now. So I believe predicted that in December it would be 2%. Well, that's looking like a horrible prediction at the moment because obviously inflation's a lot higher than that. But when you look at what's happening out there, prices are coming down. Supply chains still seem to be a bit constricted. Unemployment is at its absolute bottom. It can't go any lower than it is. So that probably starts to trend upward. So I think we're going to see lowering inflation as we move into the end of the year. Interest rates, if I had to bet right now, I would say yes, absolutely there. We've got by the time this podcast airs, the September increase will have already happened. Will there be another? Coincidentally, yeah. Will there be another one in October, November, December? My gut feel is no. I could be totally wrong on that. It all depends if the Fed and the Bank of Canada have said to themselves, you know what, we are crushing inflation. We don't care if we kill the economy. We don't care if everybody's unemployed. But I can't see how going into midterm elections in November in the United States that they can deliberately crash the economy unless that's what they want to do because, well, we got to flush things out and get it done.
There's a lot of factors that are super macro here, right? Like there's oil and there's war and there's elections. And so that's why you can't make a prediction because there's just so many things going on. That's pretty tough.
So forget about the predictions then. Let's talk practical advice. So if someone is watching us today and they are on the edge financially or they know someone who is, their kid, their parent, whatever, and they realize, okay, interest rates are trending higher, the real estate market is kind of fading. So what kind of practical advice can you give someone like that?
Okay, so a few things. Number one is cash flow. Monthly cash flow is what kills people. How much debt you have and all that stuff is important, but it's whether you can pay things monthly that is whether you're in our office or not. There's two definitions of insolvency. There's one is not being able to service your debts as they come due, and the other one is your debts exceeding your assets, your net assets. So, but cash flow is what drives people to file. People can make things go for a long time, homeowners included, who, as we said, will keep paying their mortgages until the day they're in our office, and even beyond. But that's, I think, what you look at is how am I doing now versus 12 months ago on where I'm at every month.
Am I short?
Yeah.
Am I using credit to survive?
And is it trending worse?
Right.
Like is it getting better or worse? Like, cause so if it's been trending worse for a while and things aren't looking much better in the next few months, it's always better to get help early in our business. The earlier you get help, the better you are for a few reasons. One, the big one being people make bad moves. And it's very hard to undo bad moves in insolvency because insolvency has, look back periods, let's call them, of 5 years where we look at transactions. Did you transfer your house to your wife? Did you pay one creditor versus another? Those are all things you don't want to do necessarily, depending on your personal specific circumstances. And the only way to avoid that is to talk to somebody who knows about those things. You mentioned, it's either for yourself or someone you know. That's a big thing. If if you know somebody who's in this, they might be looking for help and they don't want to come and say it. I've seen that lots of times where, someone has brought their parents or their kids in or whatever. And once we hash everything out, we realize that the person was grateful that the person actually said, we need to do little intervention here. Okay. Because they don't know how to go about it, and it's pride and it's everything else. And if you have a trusted family member who is in any kind of financial, work or legal or an accountant or somebody, it doesn't hurt to sit down with them and just say, look, here's where I'm at. Like, this is embarrassing, but am I in desperate trouble here? Ideally, you see a trustee because we can talk about debt specifically and options, but at least I would say do that and do it as early as possible.
Yeah, because debt problems don't get better on their own. It's the same as a medical issue. Oh, I got this pain in my side. Yeah. Well, okay, if you ignore it, I don't know, is that going to make it go away?
Yeah, and time is the enemy of debt. You're right. Like it's the opposite of wine and things like that. It's the longer it goes, the worse it gets. And we see that because typically people who run into financial trouble don't come in to see us for 12 to 24 months, we figure. Something like that. It takes a while. And so those 12 to 24 months, those intervening 12 to 24 months make things worse. So in other words, if we could go back 2 years, it would have been less of a problem to deal with. You would have had to pay less or whatever, but...
Well, and maybe there would have been another solution. Maybe it's like, you know what, I'm going to get rid of my car. That frees up some cash. I can get back caught up with my debts.
Exactly,
and I'm good.
Yeah. If
when
again,
my
back
debts
to
are only
earlier,
20,000, yeah.
Right, and so if like half the people we meet, we send them away because we figure out a way for them to not do an insolvency. So, but the point is sit down as early as possible and don't wait.
Yeah, and ultimately, the thing we do the most is a consumer proposal, and that ends up being a reset.
I had that word right here, which I think you may have read upside down, but it might have come out of your own brain from doing this for 20 years. It's a reset, right? So, I talked about zooming out recently. When you're in a financial mess, even as a homeowner, if you do a proposal, you get to keep your house. So you're dealing with your unsecured debts, but you're keeping your house. That's not a bad deal, and that's certainly not the end of the world. You're going to come out of this a homeowner, and you're going to be debt free. That's not terrible.
Yeah, what's not to like about that? So I agree, and I think my concluding comment is exactly what yours is. If you've got an issue, whether it's medical, financial, whatever, talk to the expert.
Yeah.
And
do it soon.
By law, we cannot charge you any money when you come in and talk to us.
I've met people, you've met people 6 times, 10 times.
Yep.
Usually it's 1 or 2 or 3, but it doesn't matter. Like I've worked with somebody for 2 years. In fact,
that's been very common over the last 2 years because, okay, let's wait until you're back to work and then we'll.
You're right. It's actually been very
It's
common
been very common.
because they've been creditor proof until they aren't.
Yep.
Right? And so sometimes then COVID's been 2 years.
Yep.
Right? So some of these people,
it's definitely been a thing. And so if you're talking to someone and they say, well, I need a $2,000 upfront retainer to start working with you, then you're not talking to a licensed insolvency trustee. No. It's a scam unless you're talking to your lawyer or your accountant or something. So it doesn't. There's no downside to talking to an expert.
Yep.
We'll give you our thoughts. Like you said, most of the people who come to see us don't end up doing a proposal or a bankruptcy. But if that's something you need, then that's what we're here for. So so there you go. I will put in the links to the show notes, the Hoyes Michaelis Homeowners Bankruptcy Index that we talked about, and some other information on this. And, again, if you've got issues, then track us down. Obviously, Scott's available by phone, by Zoom, by Teams, whatever you want to talk to him on, or you can come into our office in Toronto and see him. So, Scott, thanks very much for being here.
Thanks, Doug.
That is our show for today. Thanks for watching and listening. If you're watching on YouTube, please hit all those buttons that you see, the like and the subscribe, and you know what all this stuff is, right? You're like a big YouTube guy. Yeah. Leave a comment if you've got any questions. If you're listening to the audio version of this podcast on Spotify, Apple Podcasts, whatever, please like and subscribe as well so you get the new episodes every Saturday morning when they are released. There will be a new episode next week. Until then, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.